Your break-even is maybe the most important aspect of your financial plan because it puts together what are the needs of your practice, your needs in personal savings, your taxes, and then what do you need at home to support your family? And we put it all together to come up with how much should you be collecting in your practice to make everything work. Largely what we're trying to accomplish with a break-even is figure out what is your current cash flow needs. From the moment that collections come in the door, we have to pay all of those direct costs. We have to pay all of our staff. We have to pay our supply costs. Then from there, we have all of our fixed expenses like rent, advertising, billing fees, insurance fees. There's a huge list of fixed expenses. After that, we need to know what are we going to owe in taxes this year? What's our current debt service? And what does that leave us with to spend? And finally, we have to understand what are you spending at home? And when we add all these together, it tells us, based upon the outflows, both personally and professionally in the business, what do we need to be collecting to make sure we can cover all of them? And hopefully through that exercise, you find that you're in what we call a break-even surplus right now, meaning you are collecting more than you need to cover your expenses. But if you're not, it's really important to understand, where am I overspending? Whether it's at home or in the practice, where am I overspending and what can I do to decrease my break-even needs? So let's start by going over the owner expenses. And the first one that we have to look at here is your lifestyle. So when I say the word lifestyle, what I'm really referring to is what are you spending at home? So what is your mortgage payment or your rent? What are you spending on entertainment? What are you spending on your kids' activities, et cetera, et cetera? Making sure that you're maintaining a budget or at least having some understanding of what are you actually spending at home is crucial to understanding your break even. In this example, we've assumed that a monthly need for this client or doctor would be $15,000 at home. The next component of this is what you'll see on the screen, profit sharing calculation. Profit sharing is really just a fancy word for retirement plan contributions. So if you've currently got a 401k plan, you might be comfortable with this term. If you have not implemented that in your practice, you might not know what that term is. Now, most of our clients that come in for their first visit have no idea how much they should be saving. That's where we as CPAs and registered investment advisors come in. We run a number of scenarios based upon assumptions of what do you want to spend in retirement? When would you like to be retired? We have our own life expectancy calculations and rate of return on investment calculations. And by using that, we work backwards to then determine how much should you be saving this year to make sure that you are tracking towards your goal to have enough assets to last beyond your lifetime based upon the assumptions we've plugged in. So in this scenario, we're using $7,000 a month as a contribution, and specifically, we're putting it in a profit sharing plan. And then we also have to understand how those contributions affect the next line item on the page, which is your taxes. We work with you in your practice to make sure that we are creating and maintaining every possible tax strategy to reduce your taxes. We would never recommend you do anything that doesn't match the IRS code and do something illegal, but we will take advantage of anything that you're not currently taking advantage of in your practice to generate tax savings. But at a minimum, even if there's no tax savings opportunities or you're already taking advantage of all those, at a minimum, we have to proactively try to estimate what do we think your taxes are going to be this year based upon your practice cash flows. And by doing that, we can generate a monthly amount that we want you to be sending to the IRS or the state, if you have state income taxes, to make sure that there are no surprises on April 15th. In this example, we have tax savings at $10,000 a month. Adding another layer here that's not always necessary, but in this example, we're using mandatory savings of $2,000 a month. That can come in a number of different varieties. One, for our clients that we know they're wanting to grow their practice by reinvesting in furniture, fixtures, and equipment. This might be a mandatory savings intended for the practice. So maybe every month we're setting aside $2,000 in a savings account so that we have some sort of funds available to go out and either put a down payment on equipment or buy equipment outright. On the flip side, it could be that maybe this client had a little bit of a late start saving for retirement, and the maximum that they can save into a retirement plan, like a 401k plan, is already being hit through that profit sharing calculation. It's just an investment account where we can put money, invest it, generate a rate of return, and let our money start working for us. And then finally, we have owner business perks. So when I talk about the word perks, I'm specifically talking about those expenses that you get to deduct for tax purposes that maybe a doctor that was not an owner of a business, so maybe they're an associate getting a W-2, would not legally be allowed to deduct. So it might be things like your cell phone, maybe it's a portion of a car payment or some car expenses, some travel expenses, maybe some meals that are business meals that otherwise for a W-2 employee are not deductible. We have to make sure that we account for those because they're spent out of the practice, but they're not necessarily a direct cost or a fixed cost. They're in their own category of perks. So in this example, we use $2,000 a month. And when we add up all of those different components, the lifestyle, the profit sharing, the taxes, the mandatory savings, and the business perks, in this example, we come up with a total owner expense of $36,000. Again, most of this are things that are happening after you've taken money out of the business, which means these are after we've calculated our profit.